thank you everybody for joining. As I mentioned earlier, feel free to comment any questions or comments in the Sperax AMA chat above this channel. I, of course, am Hunter, the community manager over here at Arbitrum. Today I'm speaking with Alec, who is a T-Shot over here, business development over at Sperax. Speaking with Nicholas, economic research over there at Sperax, as well as Ray Young, who is working on the smart contracts over there as well. How's everything going, guys?
Very good, thank you.
Great, really glad to be here.
Yeah, no, for sure. Before we do get into all the questions that were submitted earlier, I do just want to give people a little bit of background on Sperax. Just in case they aren't too familiar with the project, so we can kind of get a good overview of what we're talking about today. So maybe if you guys want to start, can you kind of like a quick explainer about what Sperax is?
Yeah. I'm happy to take this one. So Sperax, at a high level, we're a software development company, and we build open source experimental financial software, which we deploy on public blockchains. And we're starting with our favorite public blockchain, Arbitrum. We originally launched in 2020 as we were building out a layer 1 protocol. And we actually had quite a bit of success here. We had 700 stakers participating in the testnet. And a cool feature was that we were actually using a stablecoin at the foundation for transaction fees and a medium of exchange. And since the fierce competition of alternative ones, we pivoted and are focusing exclusively on the stablecoin component, and we're keeping the layer 1 for future use cases. So USDS is a hybrid stablecoin that combines the scalability benefits of UST with the stability benefits of the maker DAI. So it also has this exciting feature built in, which is called auto yield. And that means that anyone who holds the stablecoin without having to stake or claim can get yield automatically deposited into their wallet in the form of USDS. So the team is mainly decentralized. We have an office in New York City, but only 5 or 6 team members are located there. The other 15 or so are located in a decentralized fashion all over the world. And we're backed by Polychain Capital, Alameda Research, Amber Group, Jump Trading, and more. So we're excited to kind of get into the details of the stablecoin and our growth tactics.
Awesome. Yeah, and I think the whole idea of stablecoins is definitely really big now, especially with the whole introduction of government regulation and just a whole bunch of different stablecoins kind of coming out via different projects. I'm interested if maybe we can dive into maybe like your USDS stablecoin. I think one thing people would love to kind of know about it is like, how does it fare when volatility kind of hits? So I think that's when stablecoins are really tested to see how stable they are.
I can take this answer, this question. So I'll start by briefly describing our stability mechanism, and then we can mention what happened like over last week when it was pretty much the first stress test that our stability mechanism experienced. So when it comes to building our stablecoin, our main constraint was to have a stablecoin that can operate fully on chain. So for the sake of transparency and centralization, we wanted to have a stablecoin that would be 100% built on chain. It won't rely on any off-chain reserves. So having that in mind, we really had 2 main options. We could either build an asset-backed stablecoin, a stablecoin that is collateralized by other cryptocurrencies, or build an algorithmic stablecoin. Both of those directions have some benefits and some limitations. When it comes to crypto collateralized stablecoins, they are quite robust because they usually are over collateralized to make sure that any volatility of the underlying collateral won't affect the stability of the stablecoin. But of course, this comes at a great cost of scalability. So asset-backed stablecoins tend to be way less responsive to market conditions. So when demand changes, it's not as easy to mint a large amount of such stablecoin because you need to have it backed 100% with underlying collateral. On the other hand, there are the algorithmic stablecoins, which tend to be pretty great when it comes to scalability, but their model is quite reflexive, which is to say that such stablecoins have their value being linked directly to the protocol, and the protocol has value only because of the stablecoins. So you have like a loop there that is not as great from a robustness perspective. So the idea was to get both features combined. So our stablecoin is explicitly collateralized by external collateral and implicitly collateralized in an algorithmic manner using our governance token, SPA. And the interesting design there is that that's a dynamic mechanism. So we launched with 95% collateral, 5% algo stabilization. But as time goes on, we become more and more algo-based. Specifically, right now, the protocol is calibrated to become more algo-based by about 1% a month. But what's even more interesting is that our reliance on the algorithm versus crypto collateral also depends on market conditions. What do I mean by that? When, for instance, we observe a lot of buying pressure for the stablecoin, a sudden increase in demand, which will translate in the peg breaking upwards, then the protocol will adjust and will become much more algo-based, which is to say that to mint more stablecoins, a higher amount of our native token will have to be burned. But on the flip side, if there is, let's say, a recession within the Sperax economy, and there is a sudden drop in demand for the stablecoin, which would lead to a temporary drop on the price, let's say going under the peg, then the protocol would respond to that and require more collateral to mint additional stablecoins. So effectively, the reliance, our stablecoin would become much more similar to a crypto-backed stablecoin like DAI during a recession, and will look much more like an algo stablecoin like Terra during an expansion, capturing the benefits of both designs. And with that in mind, last week was the first stress test we experienced. Luckily, we did not lose the peg for more than 2-3 minutes, and any peg deviation was dealt with great arbitrage opportunities. What do I mean by that? Our design offers a really interesting arbitrage opportunity where market participants can make money whenever the stablecoin has a price different than $1. That's because we offer a on-chain swap mechanism that allows people to swap our stablecoin for $1 worth of cryptocurrencies at any point in time. So if our stablecoin suddenly trades less than $1, people have an incentive to buy stablecoins from exchanges or from Uniswap, and then swap them on chain for $1 worth of crypto, effectively pocketing all the difference. So the larger the deviation from $1 is, the bigger the arbitrage profit is going to be for a market participant. And by doing this arbitrage action, they actually change the supply of the stablecoin. They increase the supply of the stablecoin if it trades above the peg, and they decrease the supply of the stablecoin if it trades below the peg. So eventually, supply will always meet demand at $1.
Very interesting. So in a way, you almost have this kind of, lack of a better word, like this Frankenstein of like a stable coin where you have two kind of different mechanisms working together, and with one of them kicking in when the need is there, right?
You can think of it along those lines. The reason we did that is I find algo-based stablecoins extremely elegant, and I actually started my career in crypto as a researcher at Terra, so I have been extremely familiar with how algo stablecoins work. A big problem with that design, though, is that, as I said before, they are quite reflexive, which is to say that the governance token has value only because the stablecoin has value, and the stablecoin has value only because the governance token has value. So this can lead to periods of instability if market conditions are not right. Hence, we thought having that backstop with a crypto collateral would make for a more stable design over the long term. And of course, the fact that we have collateral allows some other interesting opportunities that we'll talk later, when it comes to yield generation, because that collateral can generate some juicy yield for the stablecoin holders, which is just an added benefit on top.
And actually, I would actually love to actually get into some of that now, and I think that relates to the auto yield mechanism. If you can kind of maybe, Nico or whomever would be the best person to answer it, can you kind of let us know like what auto yield is, how it works?
For sure, would love
that.
to take this question as well. So the design is actually not as complicated. What we do is we take the collateral that is backing the stablecoin and we redeploy it on external DeFi applications that have been whitelisted by governance. So because governance is not fully ready yet, the decision happened in a more centralized manner, and we picked a safe DeFi application like Curve. And I call it safe because Curve being a stable AMM, the risk of impermanent loss is pretty low. So we thought that redeploying a collateral in Curve is not a particularly risky option. So what we ended up doing with that is we take all the collateral that is backing the stablecoin, we redeploy it on Curve, and we generate some yield out of that. That yield comes from trading fees as well as CRV tokens. And then we take all of that yield and we transfer it to the end user in an automated manner, in a gasless manner. The way that happens specifically is the following. The yield gets generated, we swap the yield for USDS, and then what we do is we have effectively bought back USDS from the open market equal to the value of the yield generated, and then we rebase USDS to the end user proportion to their holdings. So if you hold 1% of USDS, you will receive 1% of the yield generated. And we burn the USDS we bought. So effectively, because we take advantage of the rebase feature to distribute yield, we achieve a design where all users can get the underlying yield without having to interact with any smart contract themselves or without having to spend any gas. So we think it's an interesting feature because that makes our stablecoin it auto compounds. So just by holding the stablecoin, it increases by an amount equal to the yield generated on the external DeFi applications, which for now it's just Curve. But as more and more DApps are being built within the Arbitrum ecosystem, we plan to integrate more investment strategy outside of just redeploying only on Curve. So this is an area I'm particularly excited about.
Very interesting. That almost because I mean, obviously when you're doing DeFi, there are kind of multiple levels. Multiple layers of DeFi. I would actually say, like you have like kind of like those base protocols like Curve, and then of course you have the auto compounding protocols. Let's say like Beefy or Adamant, or Urine, for example. So in a way, you're kind of almost like not even needing to use an auto compounding protocol because the token itself auto compounds on its own.
Exactly, and then if you use that token within an auto-compounded protocol, I think that's when you can have some really interesting synergies. Like effectively, our stablecoin is able to keep increasing in users' wallets while being backed at the same time. Like the backing does not, because all the increase is organic. Is the increase that is matched by the yield generated, which is not an inflationary increase, is not an unbacked increase. So I think especially when it comes to rebase, it has many negative connotations for many people because usually it just means high APY that is achieved in an inflationary manner. In our case, rebase is just a tool to achieve a gasless transfer of the underlying yield generated in an organic manner, in a manner that we think it can be maintained as long as there are good DeFi opportunities.
Speaking of opportunities, I know along with the release of the USDS token a little while ago, shortly after you guys released your farms, those being on Uniswap V3, how have those gone so far?
Hey, I can introduce this. Yeah, so the farms. The farms are really interesting because first I want to note that this is the first live farm using Uniswap V3, so we get a couple cool benefits. Like we have automatic concentrated liquidity, for the stablecoin pairs. And we also have automated concentrated liquidity for the risk pair as well. So we get to kind of harness the power of V3 to deliver more transaction fees to LPs. But we also feature a fixed APR model, which is really unique. So as the farm grows in popularity, your per block distribution or per day distribution of SPA won't decrease as new farmers enter the pool. So, other pools might start at a really high APR and then, decrease as the farm grows in popularity. Our APR will actually remain constant. So we're really excited about that, and we think it performed fairly well. So using these first 3 farms as an example, we attracted over $8 million worth of mints of the stablecoin. So we're over 8 million circulating today. And it actually caused over 3.5 million SPA to be burned in the process. So that value accrual mechanism is already taking effect. And the most recent farm that we launched this past Wednesday got totally subscribed in just 10 minutes. So this was actually like a total shock to us. And, we're very humbled, and we're excited to see that, there's so much interest. But it actually did subscribe in just 10 minutes. So the stablecoin farm has over $10 million of liquidity in it. And we love this because that enables users to swap over $2 million worth of stablecoins. So you could actually do a USDC to USDS swap or USDS to USDC swap for $2.5 million and only have 0.5% slippage. So this is actually the most liquid stablecoin from a swapping perspective on Arbitrum today. So we're really stoked on that. And we're going to continue to work toward, using these farms to increase USDS usability at an infrastructure level. So we're going to continue to use the farms to grow the circulating supply. And I guess the final point on the farms, it's really worth noting that we've only used 20% of the budget allocated. So there's plenty of more farms to come. 20% has already seen some pretty exceptional statistics. So we're excited to see where we go, but we're feeling pretty comfy being able to do $2.5 million swaps with less than 1% slippage.
I will say, by the way, in addition to that, because that's also very, very important on a growing ecosystem like Arbitrum is, liquidity like that concentrated. But also the other thing is being able to kind of more or less promise that return in terms of like the farm yield. That's really important, especially from like a marketing perspective. Because like if you find a farm that doesn't have that much deposited into it, but there's huge APY, huge APR in it, you're probably not going to share it. You know what I mean? Like you're not going to share the alpha because you want that high APR. But if it's more or less like again, as I mentioned, guaranteed, then it's not really that big of an issue. If anything, it's better for you because the protocol gets more attention on it. So very good marketing move actually as well.
But yeah, thanks. It really was a big almost experiment, and we're running experiments. We're seeing the results, and then we're iterating accordingly. And we're just we couldn't be happier with the results of those first 2 farms. Yeah, we're excited to continue to launch more.
Awesome. And before we do jump onto the roadmap and then the questions thereafter, the last thing I kind of wanted to touch on as well was the kind of the whole design you guys have behind like I guess you could say your platform in general. You guys have a couple things going on: the ability to actually mint tokens, obviously redeem as well as farm. I'm wondering what was your thought process behind designing for like a better like UX perspective, especially because Web3 UX is like one of the most important things.
Hey, sure. I guess I can take that question. So, hi, I'm leading the product for Sperax. So we did a lot of research. We spoke to a lot of users, and we analyzed all the other stablecoin protocols. Uh, and we realized like this can be a challenge, and we spent a lot of time perfecting our mint and redeem. We did a lot of beta testing, just using the mockups with a lot of users, and finally came up with this design. We did, get inspired a lot from Uniswap per se. And if you notice, like we provide an interface to add liquidity on our dApp ourselves. So the user, if they have the initial tokens, they wouldn't have to leave our dApp for anything. Like if you notice, usually in liquidity mining for other protocols, you'd have to first add liquidity in SushiSwap or Uniswap, and then come back with your LP token. So that those are the problem areas we saw, and then we solved for it to make it really simple for small retail users to use our product. Yeah, so I mean, ultimately we are trying to solve it for retail users and trying to make crypto as obscure and simple as possible for the end users. Also, I think, admittedly, I mean, the UX that Arbitrum provides, I think, is it's much superior. As a layer two blockchain, transactions are much smoother, much faster. Gas costs are much cheaper. So that sort of adds to the overall user experience benefits of being a dApp, which is playing in the Arbitrum chain.
Why, thank you. Uh, and I think that's such an interesting thing to think about because and I should also shout out that our person that's leading product over here is also in the audience there. What's going on, Val? Um, UX is so important, and I really started to realize that over the past couple of months, just working at Arbitrum and just in general, and like kind of what you guys kind of did there, the ability to pretty much add liquidity to like the Uniswap pool without actually visiting Uniswap. Um, it's a very interesting way to do things, and it streamlines it a lot more for the end user, so they don't have to worry about going there first. And it's something that I remember, like back in the day when I was doing a lot of farming myself. The last thing I would think about is going to swapping exchange, whether it be Uniswap, SushiSwap, what have you, depositing it in there, and then coming back to the auto compounding farm, which was, I think at the time I was using Beefy Finance. But you know what I mean? Like it's such a hard thing to figure out from a UX perspective, and I think that goes very, very overlooked. So you guys are definitely doing great work on that front as well. I got to give you props there. But before we do again into the questions, can you guys give us a little alpha? We don't give us alpha. I should have reword that. Just let us know what's on your roadmap. You can give us alpha if you want, but roadmap specifically.
Yeah, I'm happy to jump on that one. This is Ray. So in terms of our roadmap, we're very excited. First of all, we've got the stable coin, that's our base, and then we're just going to add on to it. And we want to just build an ecosystem for not only for ourselves, but for our partners and our users. Of course, they're the ultimate beneficiaries of it. And as with that in mind, what we're looking to do next is we're going to have staking that's going to be coming out in the next few weeks. We'll have a DAO, we'll have lending, we're looking to deploy on other chains potentially, so that we have ubiquity across multiple chains. We're looking to have derivatives as well, and then partnerships with other protocols. That's going to be important, right? So having partnerships with other protocols where we have synergy with them, so that we create this ecosystem that is going to be exciting for our customers, for our users.
And I can elaborate a little bit more on the kind of partnerships and like business side of things. So step number one is we need to increase the circulating supply of the stablecoin. That is to basically satisfy any future need or any future use case. We don't want to run into any liquidity constraints. So step number one is launch Uniswap farms, already done. Step number two is to build a partnership with a pegged asset AMM, and that's also done. So if you follow Sperax or Saddle, you'll see that just last week, the Saddle community approved of a USDS meta pool on Saddle. So what this allows for are new exciting routing paths for large trades, and it allows us as Sperax to build new exciting applications like borrowing and lending protocols. So once we have that liquidity, then we can begin to focus on integrations with other dApps. And we've already began those conversations. So we have a great relationship with the team over at Tracer, as well as GMX. And the cool feature of integrating USDS as collateral in a protocol like Tracer or GMX is that the collateral sitting in the reserve. So this is, your money that you have to print assets and to trade. It'll actually be increasing as it sits idle. So you actually have a collateral pool that is growing in value and protecting you from a health standpoint. So say that in a different dApp that doesn't decrease in value, your health factor might be decreasing as your positions are not going your way. But say you even have an 8% down event in the year, the 8% delivered through your collateral appreciation would result in a net zero performance for the end of the year. So it really is something new, and it can function as a financial primitive because it's effectively a collateral pool or a line of credit that earns interest. So very new, very exciting to see what people will build with this new financial primitive. And then in addition, we're talking with many centralized exchanges, particularly ones that have direct to Arbitrum withdrawals and deposits. That way people don't have to deal with the process of bridging from layer 1 to layer 2. So that's going to be a huge user experience boost, once we get listed on those centralized exchanges with those rails. And then we're already in conversation with fiat on and off-ramp partners to do direct to Arbitrum deposits of assets with bank transfer or credit card purchase. So we're trying to make this thing super liquid and super accessible.
Shout outs to BizDev for always delivering. Awesome. Well, with that being said, I guess we could kind of jump into some of the community questions. I may try to avoid the ones that you guys already kind of answered, just so we're not making you say the same thing over again. But let's get into it. So we have Intrepid User who asks, what is the targeted approximate organic yield on USDS derived from DeFi investments, not including inflationary SPA rewards?
That's a bit of a tricky one because it depends on market conditions. So I don't want to really anchor on a specific number because everything is subject to market conditions. But I can give you an idea of how the first month has been. So at the moment, the APY on the Curve 2 pool, where most of our assets have been deployed, is at about 8%. But the actual APY that users receive is a bit higher for the reason I'll explain shortly. So the way we structure this is that only USDS on user wallets is eligible to receive the yield. That means that for now, if you lock your stablecoin on a smart contract, you won't be able to receive that yield. Of course, this will be subject to change. So when we introduce governance, whitelisted dApps will be able to receive the yield. So if you lock USDS within a whitelisted dApp, you will be able to get that yield. But for now, since that's not the case and the yield only goes to the actual holders, it means that only USDS holders who are not liquidity providers will be receiving that yield, so that the effective number ends up being between 15 to 20%, which is it's a pretty decent number for a yield that gets paid on stable coins without you having to suffer any loss on your principal. We are also working on how we could get better returns on the CRV component of our yield by using something like convex finance. So we expect that within the next 2 months, we will be able to increase that yield even higher. But again, I don't want to promise on an exact number, because as I said, that's an organic yield that is generated in the market. So if the DeFi market, suddenly crashes, the yield will also be lower, but at least it's a sustainable yield. It's a yield that doesn't rely on Ponzi economics, which is what we have seen happening a lot within the space. So I'm confident, the fact that this yield is sustainable will end up attracting a lot of users, even if it's not triple digit.
Yeah, I mean, 20% or even anything close to that, of course, including the SPA rewards, is quite high.
The SPA rewards are not live yet for the yield, and something to make clear, the SPA rewards will act as a stabilization mechanism. So this is to say they won't increase the yield in absolute numbers. They will just make sure that the volatility of the yield is lower. So how that will work is we will compute a short-term and long-term moving average of the yield and use that SPA to stabilize those two numbers, to make sure that the short-term moving average is not too different than the long-term moving average. So effectively, that SPA stabilization reward is going to act as a way to reduce the volatility of the underlying yield, rather than just boosting that yield high. It's an important clarification, because the average yield will end up being a function solely determined by the DeFi market. The SPA rewards will just make sure that the volatility is not as high.
I see what you're saying. Yeah, and again, kind of going back to the whole UX thing, I think it just makes a lot more sense to try to, again, not promise anyone like a specific yield, but at least when someone checks, it's like always around the same kind of number instead of it jumping up and down with too much volatility. I definitely agree with that. Next question. Unless Ray, you want to join in there?
If you don't mind, I'd like to add a point to that.
Yeah, please.
So basically, if someone were to, deposit stablecoin in the Curbs 2 pool, instead of that, if they would be holding USDs, they would actually make a higher APY without having to incur the gas costs of continuously staking and unstaking and selling CRV tokens on Curve. So it's like that.
Gotcha. And this question actually might this next one might actually kind of play a role into the one we just asked previously. And actually, Alec, you may have touched on it a little bit, but I do just want to go over it just in case, because this is definitely an important one. Do you guys have any plans to integrate integrate borrowing/looping into USDS functionality, either by making in-house protocols or by partnering with money markets, I guess similar to what Abracadabra does with their degen docs?
Yeah. So absolutely, we're working on that. And just so you understand how we're thinking about that problem, we view USDS as the perfect line of credit, almost like the line of credit of the future. And that's because this is going to be the first time that you can take a loan against assets, and that loan will be automatically repaying the loan in real time. So this is very similar to like an Alchemix type experience. And what it can do is produce a strategy that in traditional finance is oftentimes called portable alpha. And it services a subsection of the market that's long Bitcoin. What you can actually do is take a loan against that Bitcoin in USDS, and the auto yield functionality will be producing free cash flow that is available for this investor to basically put into their pocket, due to the fact that the principal USDS is actually going to be used to repay the loan. So any interest accrued will be a profit that will be kept by the end user. So that is a very, very new experience for borrowers. And we're very excited to wrap that into one product, which will be, presenting more details on very shortly, but I'll tease it a little bit there. So it's going to be automatic free cash flow and a line of credit that pays you money without you having to do anything.
Yeah, dude, you're talking about Web 4 stuff here. Like we're already past we're already past Web 3 now. Yeah.
Yeah, well, a lot. I mean, this is already being done so much. Like, so users all the time, they'll deposit their Ether to Aave, take a loan against it, or even just like mint DAI, and then go lend that DAI for a couple percentage points, right? But you have to be both a finance expert and a crypto expert just to get something as simple as loan against your collateral, go deploy the stable coin to earn 3% to 5%, whatever. That's actually extremely challenging for the average user. So now, thanks to composability and thanks to crypto and open source nature of blockchains, you can wrap that whole experience into one product. So with one click of a button, the smart contracts can take that loan, swap it for USDS, hold that in your wallet, deliver your free cash flow, and automatically repay back the loan. So now this end user can harness the power, promised by DeFi without having to be a finance expert nor a crypto expert. So we think you can finally deliver, what DeFi promises, what crypto promises to those who may not be as sophisticated financially or technologically as some of us nerds here.
I am proudly a self-proclaimed nerd and or geek, if that matters.
As are we.
There you go. There you go. We got a next question, and I guess I'll reword this a little bit so maybe we can be delivered a little better. So, with other stable coins already out there, potentially offering like respective yields of, let's say, around like roughly like 5 to 10%. How does USDS differentiate itself currently and plans on setting itself apart in the future?
Yeah, I'll take this real fast. So I briefly touched on it, and so did Ray here. Basically, if you want to do something as simple as lend a stable coin, there's like 4 or 5 different transactions associated with it. There's all these different knowledge barriers associated with it, and all of these, all this noise in the space. Basically, people that are trying to take your crypto from you. So it's extremely challenging to do anything beyond just kind of like, hold a stable coin. So if you want to put it to work, it's quite challenging. So auto yield is the first key differentiator, being that you don't have to do all of those gas fees and you don't have to have the expertise in order to harness the yield. And then number 2, we are strong believers in the upcoming economic activity that will be happening on Arbitrum. So we want to front run this rush to Arbitrum by being the most liquid stablecoin in the ecosystem. So as builders and as users enter the ecosystem and they begin to look around for assets to integrate into their protocols, we'll be the obvious choice, considering we'll be the most liquid and deliver users the best price on stablecoins for large swaps. So those are the 2 primary ways: auto yield and being the obvious choice from a liquidity standpoint.
And even to throw you guys another bone there, I mean, I'd almost throw in the UX as well. I mean, like a stable coin with its own farming platform, like kind of built in. I don't know. I mean, I think that on its own is definitely a very attractive feature, if you ask me. Let me take a look here. Here we go. This one actually I would love to know as well. With SPA single staking on the way, in just, I guess he's saying in just a few days, is the estimated APY fixed like the dual token farms, as we mentioned earlier?
I'll take that. No, it'll just be a single token, so there'll be a VE version of SPA. So
I
you'll
think it's talking about the single staking before the V SPA launch. Yes, the single staking farm, I mean single-sided farm, which we will launch, where you can stake SPA to earn some SPA. That will also have a fixed APR and fixed budget as well, like the other farms.
Okay, so there'll be two different ways to stake your SPA essentially.
This is something we are launching before we launch the VSPA contract.
You guys are really just bringing on the farms, huh?
I can add some flavor there for
Please.
what was our framework. So we wanted to have a staking mechanism launched as soon as possible to make sure we can have good dynamics when it comes to disposable supply. Effectively, we wanted to be able to lock a big part of the circulating supply to ensure that we can have healthy price action. And of course, our first choice was to have a model similar to the V design that Curve started. Frax has done something similar, and but because this takes a little bit longer to actually implement, we decided to introduce a simpler staking protocol for the first 2 months, and then this simpler model will be replaced with the more sophisticated structure. Where I can, if you want, I can briefly describe how we're envisioning to set up our governance, which I think is going to be also pretty interesting.
Oh yes, please do. I should have asked about the governance. Yeah, of course.
So as I said, it's going to be a V model. Effectively, that means that the longer you vote your SPA tokens, the more voting power you're going to have. So people who choose to vote their SPA tokens for the maximum period, they're going to have the maximum possible amount of voting power for a given amount of stack, for a given amount of SPA tokens. And then the voting power will be crucial for all the governance decisions. So whether we're going to add a new type of collateral or whether we're going to add a new investment strategy, all of those things will be subject to governance. So we plan to fully decentralize decision making of SPA protocols. So SPA holders will be able to decide all of those things. And that's the reason we launched the farms now, because we really wanted to decentralize the holdings of SPA. We don't want the foundation to have all the voting power. That's why we launched all those farms. We have been a bit aggressive on decentralizing the holdings of SPA. And then based on your voting power, you will also be able to receive some other interesting benefits, specifically all the fees generated by USDS. Whenever someone mints or redeems the stablecoin, the protocol captures some fees. So all of those fees will go to people who stake their SPA, as well as future SPA emissions. So all SPA inflation will be influenced by SPA stakers, will go towards either SPA stakers or where SPA stakers vote that inflation should go. Also, if you're a SPA staker, you will be able to receive a higher yield as a liquidity provider. So being a liquidity provider of any Sperax asset will give you a higher yield if you're also a staker at the same time. And finally, which is also interesting, we will consider having some form of revenue sharing from the USDS collateral between USDS holders and SPA stakers. But yeah, this will be subject to a governance decision. But the idea is that by staking your SPA, you will be able to also capture some of the revenue generated by the USDS collateral as well in the future. So if you are bullish about USDS, if you think that the USDS is going to have a higher circulating supply in the future and more assets under management, then staking your SPA is going to be the best way to capture all of this value. And yeah, I'm really excited about introducing the V model. Hopefully it will happen within the next 2 to 3 months.
And is there I mean, I guess you can answer this if you want. Obviously, if it's not locked down yet, let me know. But 2K Minera asks, is there a minimum lockup time for those who choose to stake their SPA, or will it just be kind of you can lock it up and then take it out whenever?
So for the single staking model that we're going to launch really soon, this happening, for the simple staking model, yes, we're considering to have a 7 days lockup. For the V model, is going to be flexible, but of course, the longer the lockup period, the higher the benefits. So users will be able to make a decision based on the risk-reward trade-offs.
Awesome. Yeah, no, I mean, obviously, it's kind of crazy how like the two token kind of design works, especially when we're dealing with stable coins. You kind of think of one as like the stable asset, and one of us, I guess, it's more like the volatile asset. I don't know if that's a good way to describe SPA, but it's interesting that you mentioned earlier, like if you're bullish on USDS, it's like, you know, someone coming new into the ecosystem would probably just buy USDS and expect it to go up.
Exactly. A way to think about it that is quite helpful is the SPA effectively, the SPA supply absorbs all the price volatility of USDS, at least for the algo component. So effectively, if you expect that the USDS demand will go up, and you know that means that there are going to be periods where for a short-lived time USDS will trade more than $1. This will lead to SPA burn. On the other hand, though, if you think that USDS is going to suffer a recession, this will lead to SPA being diluted. So effectively, by holding SPA, you take a stance on whether USDS will keep growing or not. And if USDS keeps growing, then by design, SPA will capture all of that value.
Something worth noting, like we can already look to prove out this kind of value mechanism. So thus far, we've minted, or not we, you know, the community has minted $8 million worth of USDS. And that has caused the burning of almost 4 million SPA. But there have been 400,000 minted. So there's a net burn of 3.5 million SPA. And as Nico mentioned, you know, as USDS grows, it will cause a net burn of SPA, even though there's a small amount of SPA that's, you know, minted when USDS is redeemed. As long as we can do our job well and bootstrap the demand for USDS, it should cause a significant value accrual effect to SPA.
Which will increase over time since USDS is going to become more and more algorithmic as it matures as an asset. So on purpose, we want it to be mostly asset-backed at launch to make sure, you know, that we get trust, that we grow in size. Like algo stablecoins are pretty hard to bootstrap. So we want to kind of sit and start as an asset-backed stablecoin, but then as we mature, as we grow, converge towards a more algo-based design. So yeah, the expectation is that the burn will increase over time, assuming we do our job well and bootstrap USDS demand.
Yeah, we don't need any malt or iron events.
Oh no. Oh yeah, no, definitely not. None of that. It's definitely worth mentioning as well. That it sounds like you guys put a lot of work into, you know, actually, you know, making sure that not only, you know, you have like two different tokens that work in tandem together, but that it's that's like that's safe to use more or less. You know, obviously, you know, audits are a very important thing, and I know that yeah, you guys have mentioned that you've gotten some. But just even like kind of with the whole model you have, with the whole having collateral to back it just in case in the beginning, and then moving towards a more algorithmic approach, is a very interesting way to do things. Again, from a safety perspective as well, because I think that's very overlooked, especially in crypto, which really, in all reality, safety and security is like one of the most important things.
Yeah, totally. I mean, we could have like made the budget for the initial farm massive, and it would have caused a significantly larger, you know, circulating supply of USDS in the first couple of days. But it's just subjecting our whole community to unnecessary risks. You know, we're here to build for the long term. We're building infrastructure for the metaverse, and a slow tiered rollout is a necessary trade-off if we want to deliver the security, you know, that we envision for our users. Might be a little bit less exciting in the early. What it delivers is comfort, trust, and security for the end user.
And I would actually love to ask one final question before you guys maybe want to kind of throw in anything yourself. But how do you guys see USDS? Because I assume it'd be USDS mainly, kind of being integrated into like NFTs, or as you said, Alec, kind of like the metaverse. I mean, I think we all know it's been like the huge thing last year and obviously this year so far. the metaverse, NFTs, and stuff like that. And I'd almost bet that stablecoins are going to have to play a big role in that. Do you guys see kind of USDS playing a role there, or what are your thoughts on that?
Yeah, so I can speak briefly to the metaverse. So, I mean, I grew up playing games like RuneScape. So I'm very familiar with like this idea of like you're going to be in the metaverse, but you're going to have what feels like a savings account that you bring with you as you begin to enter different ecosystems, different apps, and different metaverses. So what that means is you can be basically having a checking account and a savings account. Sperax will be the savings account for the metaverse. And what this means is, USDS will be liquid enough to act as a medium of exchange, a traditional money or a traditional currency. But thanks to auto yield, this now is a high interest savings account for the metaverse. Anyone with an internet connection that has the desire now has access to a US dollar denominated account in the metaverse. And that's really how we're going to position ourselves. So we're speaking with gaming companies, and we're really just trying to be that financial services provider at an infrastructure level for any metaverse company. And then from the NFT front, there's a cool opportunity to do the port alpha strategy. So say you punk, you can unlock the liquidity from that punk and start earning yield on it. But that's very comparable to the same experience if you were to lock up Ether, lock up whatever it might be. And then paying for NFTs, of course, from the money standpoint. But beyond that, there's not too many NFT applications yet.
Yes, there you go. Yeah, I was just gonna say.
Mm-hmm.
By the way, love the RuneScape reference in the beginning. I think at some point we were all RuneScape degens. In our heyday. But before we do kind of close things out here, looks like we're coming up on the hour mark. Did you guys maybe just want to any last thoughts maybe you wanted to kind of give the audience before we do end off?
I guess I'll take this opportunity to market a USDS USDC farm, which is live. It is actually having the least impermanent loss. It's a stablecoin farm, very healthy APRs of 15%, which is for the no lockup option. And if you lock it up for the longest period, you'll get an APR of 30%. So that's kind of like a very stable investment choice that you can make in the Sperax farm ecosystem. I would say the farm is very successful. It has already raked in more than $4 million of liquidity in Uniswap. So if you look at the overall farms in Uniswap, it would be, I think, in the top three right now. So yeah, I mean, that's something I wanted to put across.
Of course, not enough financial advice. But great. I'm going to leave as well the Discord to Sperax in the Sperax AMA chat. So make sure you guys join. If you want to obviously contribute or just kind of hang out in the community. And yeah, with that being said, thank you guys so much for coming on today. We look forward to seeing USDS be used everywhere. And yeah, with that being said, I guess we'll get out of here.
Thanks, Hunter. Thanks, everyone in here for listening.
Thanks for coming on, y'all. This will be available on YouTube afterwards as well, by the way. So just in case you missed it.
Thank you.
All right.
Thank you for your time.